On est ravi de vous accueillir pour premier événement dans une série d'événements qu'on va lancer dans le cadre du centre Business Economics, un centre qui est en cours de création. Et c'est pour ça qu'en introduction, je voudrais un petit peu vous présenter ce qu'on fait, ce qu'on compte faire, avant de donner la parole à John pour le sujet principal d'aujourd'hui. Le centre, en fait, il n'est pas officiellement créé, mais il est parti d'une idée ou plutôt d'un double constat. Premier constat, c'est que depuis 2019, les États et les entreprises dans le monde subissent des chocs systémiques à l'échelle internationale. Donc ça a commencé avec 2019, avec la Covid. Ensuite, il y a eu la crise ukrainienne qui a déclenché l'épisode d'inflation. Et puis, il y a d'autres choses. Il y a bien évidemment la crise du changement climatique qui est là pour durer et qui commence à se manifester dans la vie quotidienne des citoyens, mais également dans la vie des entreprises. Donc ça, c'est le premier constat. Et puis bien évidemment, il y a des choses, et John va en parler, il y a des choses qui se profilent également pour les années à venir. On voit que le monde est rentré dans une phase un petit peu de tension géopolitique et que ce qui s'est passé aux États-Unis n'est pas là pour apaiser les tensions. Au contraire, ça va monter crescendo et les entreprises et les États vont être impactés. Le deuxième constat, c'est que historiquement, dans les business schools, on avait très peu d'économistes et il y avait une raison pour ça. Parce que la science économique n'était pas mobilisable, n'avait pas suffisamment de données pour adresser les questions concrètes des entreprises. Si je prends le cas du Maroc, l'appareil statistique marocain n'offre pas suffisamment de données ou de micro-données à l'échelle de la firme ou de l'entreprise. Si on veut faire de la microéconomie ou de l'économie industrielle comme ce qui se fait au niveau de la chaire, au niveau de l'équipe de Anas Lahlou, c'est très compliqué au Maroc. La donne est en train d'être changée parce qu'il y a de plus en plus les données qu'on qualifie de non conventionnelles. Donc tout ce qui est big data, à travers les réseaux sociaux, à travers le système satellitaire. Donc ça, c'est une source d'information très riche qui a ouvert un champ d'analyse économique qui a rendu intéressant la science économique pour des questions purement business. Alors que sur les 2 dernières années, c'était principalement des questions de macro, de secteur, de politique publique. Donc le double constat a amené le management de l'université à penser à créer un centre de compétences sur les questions de business economics. On a 3 ou 4 économistes, un peu plus, une dizaine d'économistes au niveau de la business school, il y en a pas mal au niveau de la FGES. Et l'idée, c'est de rassembler cette communauté sur des questions d'entreprise qui vont être identifiées à travers des liens qui vont être développés avec les entreprises. Donc c'est pas de la recherche académique, on choisit des sujets, on publie. Non, il faut que ça soit orienté vraiment business et sur des sujets concrets. Donc Hadawa, vraiment la philosophie du centre. Et le centre a été conçu pour connecter plusieurs domaines. Donc il y a le domaine bien évidemment de tout ce qui est sciences économiques, donc les concepts, les outils, les frameworks de la science économique, les différentes branches, hein, la macro, la micro et d'autres aussi. Il y a le domaine aussi de tout ce qui est regulation et public policies. Ça aussi, on a vu hein, avec les crises, les États prennent des mesures au niveau monétaire, au niveau fiscal, au niveau social, et ça impacte les entreprises. Ça impacte leur compétitivité. On peut parler des droits de douane de l'OCP pour accéder au marché américain, mais on peut parler aussi pour les producteurs de electrical vehicles chinois pour accéder au marché européen. C'est-à-dire les tarifs sont en train d'être utilisés dans les politiques, dans la géopolitique, et ça impacte les entreprises. Donc il est important à l'échelle de l'entreprise de décrypter ce qui se passe au niveau des regulations. Et puis il y a le fil rouge, en fait c'est le fil rouge de tout ce qu'on fait au niveau de l'ABS, c'est la sustainability. Donc je pense quasiment tous les centres, Anas ne me démentira pas là-dessus, c'est vraiment un fil rouge qu'on retrouve dans ce qu'on fait comme formation, comme recherche, et également comme advisory. Donc cette perspective est quelque chose de nouveau. Historiquement, les business schools étaient principalement orientés. Donc c'est ça la philosophie, c'est de mobiliser les outils au service des décisions. Alors je précise, c'est pas les décisions opérationnelles. Donc on fait pas de OR, on fait pas d'algorithmique, on fait pas d'optimisation opérationnelle. C'est pour des questions d'ordre stratégique. C'est-à-dire des investissements quand une entreprise veut augmenter sa capacité de production. quelles sont les anticipations ou là, les impacts que ça peut avoir. Un leader comme l'OCP, quand il rajoute une capacité de X millions de tonnes de production de phosphate et de fertilisants, ça impacte tout le marché international. Donc ça, c'est des choses qu'il faut anticiper et la science économique apporte des outils qui permettent d'éclairer sur ce genre de décisions. Bien évidemment, il y a toute une vision autour. Inch'Allah, on aura l'occasion de revenir un petit peu sur comment on a monté cette vision. Mais juste quelques idées importantes. C'est pas un centre de recherche. C'est un centre de compétences. Donc la différence, c'est que ça couvre non seulement la dimension recherche, mais ça couvre aussi les doubles dimensions education, notamment executive education, et tout ce qui est advisory. Advisory vis-à-vis des gouvernements et vis-à-vis des entreprises. Donc c'est l'approche, c'est vraiment le trityptique qui guide un petit peu tous les travaux qu'on va faire. Donc, et puis bien évidemment, la recherche, comme j'ai dit, c'est pas une recherche théorique, c'est plutôt des recherches appliquées sur des questions et des sujets vraiment concrets de l'entreprise, qui vont déboucher sur la création de ce qu'on appelle les case studies, qui vont être des sources qui vont être utilisées pour la formation et les trainings exécutifs. Et bien évidemment, tout ça est assis sur des liens forts avec l'industrie, le monde du business. Donc, c'est pour ça que la plupart de nos travaux vont être financés par des entreprises. Donc ça aussi, c'est une orientation forte qu'on s'est donnée pour s'assurer de l'applicabilité de tout ce qu'on fait. Bon, je vous passe ça. On a développé un cadre analytique. En fait, c'est pour garantir un petit peu la qualité de tout ce qu'on fait. La cohérence et la qualité de ce qu'on fait. Donc c'est vraiment un référentiel qu'on respecte dans tous nos travaux. Et s'il y a des questions, je peux revenir dessus. Et c'est des choses qu'on applique dans les différents programmes que je vais présenter. Alors initialement, on était sur un portefeuille de 4 grands programmes de recherche, formation et advisory. Le premier qui a été lancé, c'est celui de la macro. Donc comme je disais, il y a des choses qui bougent au niveau des politiques macroéconomiques au Maroc et à l'étranger. Et c'est intéressant de voir comment ça impacte et ça se cascade au niveau sectoriel et ça descend jusqu'au niveau entreprise. Donc c'est des travaux qu'on a fait. Personnellement, je viens du ministère des Finances. La Banque centrale aussi a des outils. Et l'idée, c'est de développer des outils au niveau de ce centre-là qui permettent de donner des éclairages sur ces questions-là. D'anticiper, par exemple, le Banque Al-Maghreb, elle augmente le taux d'intérêt. Concrètement, ça veut dire quoi pour moi, une entreprise de retail au Maroc? Ou là, je sais pas, l'État change le système de IS, ou là, les paliers, les seuils d'IS, ou là, change le système d'imposition des revenus. Comment ça impacte la compétitivité d'une entreprise? Donc l'idée, c'est vraiment d'injecter de la science dans ces questions-là pour même permettre aux entreprises d'anticiper à les impacts-là. Et bien évidemment, dans le workstream, c'est également aussi anticiper les impacts des crises, pas la crise de changement climatique. Il y a des modèles de prévision climatique qui permettent, et Anas a développé un modèle, au ministère aussi on avait développé un modèle qui permet justement de voir comment les différents scénarios climatiques, comment ils impactent l'économie marocaine et comment ça se descend au niveau des secteurs, voire même au niveau des entreprises. Deuxième workstream, il est dédié à l'OCP. C'est vraiment, l'OCP a l'habitude de consommer beaucoup de conseils stratégiques. Je ne vais pas citer les noms pour ne pas faire de pub. L'idée, c'est de compléter les visions qui sont plutôt des visions corporate par des visions plutôt orientées politique-économique. C'est-à-dire on prend en considération les facteurs géopolitiques, les facteurs macroéconomiques, chose que font pas les cabinets de conseil stratégique. Et bien évidemment, ça permettrait à l'OCP d'anticiper les prix, de décortiquer un petit peu les tendances au niveau du marché, mais également de voir quand l'OCP prend une décision, je cite l'OCP, mais ça peut être aussi fait pour d'autres secteurs. Quand l'OCP, en tant que market maker, quand elle prend une décision, ça impacte le marché international. Mais aussi, ça suscite une réaction des autres acteurs. Ce que fait l'OCP, ça fait réagir Yara en Europe, ça fait réagir Mosaic aux États-Unis, ça fait réagir aussi des acteurs publics et privés en Chine et en Inde. Donc c'est important d'anticiper à de l'interaction stratégique. Donc il y a des outils, notamment des outils de théorie de jeu, qui permettent justement, avant de prendre une décision, savoir qu'est-ce que ça va déclencher comme chaîne de réaction. Troisième volet, ça c'est en train de monter en puissance à l'échelle, au niveau de l'agenda international. Je ne sais pas si vous avez suivi la COP29 dernièrement. l'une des décisions majeures. Malheureusement, c'est une des COP où il y a eu très peu de décisions, mais l'une des décisions majeures, c'est qu'ils ont acté le lancement d'un marché mondial de marché carbone. Ils vont définir des standards internationaux qui vont s'appliquer au niveau des pays. Donc le marché carbone, ça sert à quoi? Quand vous êtes une entreprise qui pollue ou là qui a des émissions CO2 et vous voulez offsetter ces émissions-là, de dire voilà, je vais acheter des crédits carbone qui me permettent, voilà, c'est des droits de polluer pour caricaturer, qui permettent de continuer à produire de la même manière et en même temps d'avoir des objectifs globaux d'émissions qui sont réduits. Donc, par exemple, je reprends l'exemple de l'OCP, il a une stratégie net carbone, zéro carbone à horizon 2040 pour le scope 1 et 2 et 3, à horizon 2030 pour le scope 1 et 2. Et l'OCP, il est en train d'investir dans l'énergie renouvelable, il est en train de décarboner aussi les process industriels, sauf que c'est des choses qui vont prendre très lentement, qui vont être mises en œuvre. Donc, les marchés carbone, ça permet de combler les retards et d'acheter des crédits carbone qui permettent à l'échelle internationale de dire voilà, j'ai atteint mes objectifs sans nécessairement que ce soit moi qui a compensé. C'est ça l'utilité des marchés carbone. Et l'OCP, pourquoi c'est un acteur important? Parce qu'ils vont devoir acheter massivement les crédits carbone, mais ils produisent également les crédits carbone. Une filiale de l'UM6P qui s'appelle Innovex, récemment, il y a quelques mois, elle a fait une transaction où, à travers un projet de forestation, elle a vendu un crédit carbone. Donc, il a vendu sur le marché international la possibilité pour d'autres entreprises, différemment de l'OCP, qui permettent justement de offsetter l'émission CO2. Donc, l'OCP va être acheteur et vendeur. Et comme c'est l'acteur majeur au Maroc, il peut être également régulateur. Donc, l'idée de ce programme, c'est vraiment réfléchir au marché marocain, comment créer un marché marocain d'IEL carbone. Donc, on travaille beaucoup avec le ministère, les deux ministères, les finances et le ministère de transition énergétique, sur la conception de la loi. Et ensuite, on va travailler avec la CGM et les opérateurs privés pour faire monter en compétences, parce que c'est des sujets très techniques. Quand on veut faire une émission ou acheter un crédit carbone, c'est un process très, très compliqué. Et puis, c'est certifié par des agences de notation. Donc, c'est important d'accompagner les acteurs à travers du capacity building pour leur permettre justement de se financer ou de financer via ce canal-là. Et puis, ça, c'est le quatrième volet. On ne l'a pas encore lancé. C'est un volet qui sera, Inch'Allah, sponsorisé par l'Agence des participations, qui a été créée au niveau du ministère des Finances, qui porte un petit peu un portefeuille d'une centaine d'entreprises publiques, y compris l'OCP, l'ONCF. Et l'idée, c'est de travailler sur des questions de gouvernance, du principal agent, enfin, globalement d'injecter un peu de science dans la gestion et le pilotage des entreprises à l'échelle de l'État actionnaire. Donc, à nous, les programmes. J'ai tardé un petit peu. Et puis, bien évidemment, comme j'ai dit, il n'y a pas que de la recherche, il y a aussi du executive learning. Et on a déjà commencé à structurer une offre d'executive training pour l'OCP dans un premier temps et ensuite pour l'agence. Et ça va être ouvert à d'autres acteurs privés. Et puis, on a une équipe. Alors, il y a des personnes qui sont affiliées, comme Atewi, Amino et Anas Saidi. Mais il y a également d'autres qui sont dans l'ABS, Olga, Si Mohamed Kharbaj, qui sont dans Cluster Business Economics et qui travaillent avec nous en mode projet. Et puis, bien évidemment, on sollicite également, il y a aussi Anas Lahlou, Pierre-Noël Giraud, qui travaillent au niveau du centre. Mais sur certains programmes, on va les développer en partenariat avec d'autres entités. Donc, ça peut être des bailleurs de fonds comme la Banque mondiale, ça peut être le ministère des Finances, ça peut être la chaire. Et l'idée, c'est de ne pas rester sur une organisation qui est fermée, mais plutôt une organisation avec une gouvernance open. Donc, des staffs permanents, mais tout le reste, c'est en mode projet et selon les partenariats. Et en parlant partenariat, donc, on a bien évidemment historiquement l'ABS et le ministère, enfin l'UM6P, il a un partenariat avec le Mine Paris PSL. On est en train de mettre en place un partenariat avec la Harvard Kennedy School, le Growth Lab. Donc, normalement, le directeur académique sera là fin de décembre pour identifier les axes de collaboration. Ça couvre la recherche, mais ça couvre également la formation. Et il y aura des possibilités pour des étudiants marocains avec un échange mal Growth Lab et vice-versa. Il y aura aussi des Américains qui vont venir à l'ABS. Et puis, on est en train de monter un partenariat aussi avec Toulouse School of Economics. On va commencer par l'executive training et ensuite, on va attaquer la partie recherche. Et puis, bien évidemment, on travaille, historiquement, on a toujours travaillé avec Peterson Institute. travaille beaucoup avec Climate Company, c'est un think tank allemand qui travaille beaucoup sur les questions de carbone. Donc c'est eux qui nous aident, qui nous guident au niveau scientifique dans nos travaux. Et puis bien sûr les voisins, Policy Center, moi-même j'interviens beaucoup dans le Policy Center. Et l'idée aussi c'est de travailler avec les organismes internationaux pour lever des fonds et également de faire rayonner nos travaux à l'échelle africaine. Donc, voilà très rapidement. Je me tiens à votre disposition s'il y a des questions. Je laisserai mon adresse email aussi. S'il y a des sujets qui vous intéressent, qui rentrent un petit peu dans le champ de nos travaux. Donc, je donne la parole à Anas. He will moderate the session.
Thank you, Si Darqawi, for this presentation. Now, I will give the floor to Mr. John Baffs, who is a senior economist at the World Bank. He specializes in commodity markets and studying the markets and forecasting their prices. But besides that, he is an academic who has published many papers in reputable journals like the Journal of Agricultural Economics and Resource Economics. Without further ado, I'll give the floor to John Baffs.
Good morning, everybody. Thank you very much, Moussif and Anas, for kind introduction. And it was nice for me to also see what is your program looks like and your ambitions. Good luck to this. And I was glad to see my name and my face earlier on. Okay, great. Thank you. Just to reintroduce myself, I'm a senior economist at the World Bank. For most of my career, I have done research and analysis on commodity markets. I have worked in various divisions and departments in the World Bank, started from the Latin America and the Caribbean department. Then I did some work for South Asia, especially Bangladesh. I have done some work in the valuation department, research department, but most of my career has been affiliated with my current department, which is the Prospects Group. The Prospects Group is part of the World Bank's Development Economics Vice Presidency. And in this Vice Presidency, we are dealing with three aspects. One is research, pure academic research. So to speak. One is data, and the third aspect or department is the Prospects Groups, is where I belong. In the Prospects Group, we do several aspects of monitoring the global economy, but our main job is to publish 2 reports per year. It's the Global Economic Prospects, which is published in January and in June of every year. We are about to finalize the January edition now for the Global Economic Prospects. That's where we are monitoring the global economy. And the second publication is Commodity Markets Outlook. I have handled this publication for most of my career, but now I'm shifting the responsibilities to other people in the institution. We publish the Commodity Outlook twice a year, April and October. The latest edition was published on October 29th. In that report, we monitor, as I said, all commodity markets, I would say. That's all is a big term anyway. Energy, agriculture, metals, a bit of precious metals, and a little fertilizers. And we provide commodity markets analysis and forecast for 45 commodities, which are part of the groups that I mentioned. The presentation that I'm gonna discuss today follows mostly from it's drawn from the report, the Commodity Markets Outlook report that we published on October 29th. I'm gonna talk a bit about energy, metals, agriculture. In agriculture, I'm going to also mention some various aspects of the fertilizer markets, very interesting in the context of Morocco. And lastly, I'm going to give you the table of the forecasts. And I don't know, if you have questions, please go ahead and interrupt me. I don't mind answering questions throughout the presentation or at the end. Any way you feel more comfortable, let me know. Just to give you an idea of what are the main findings of the report. First, I'm sorry, I forgot to mention, I'm going to talk a bit about the macroeconomic environment, because we all know how certain aspects of the macroeconomic environment, such as growth, global growth, interest rates, inflation, etc., affect the commodity markets. And then, of course, I'm going to talk about commodity markets. Now, in terms of global growth, we expect for 2024 2.6% global growth, and for the next 2 years, pretty much a steady growth. This is a little lower than a historical average. The US dollar, it's very important. This is a very important variable. It's very important to monitor this variable, because most commodities are traded in US dollars, as you probably know. And so what the US dollar does, whether it appreciates or depreciates against other currency, it matters to commodity markets, regardless of whether the country is using the US dollar based or not. That has nothing to do. It's different from the fact that fluctuations in US dollars do affect the prices of commodity markets. The interest rates, we are in a very important macroeconomic environment now, because we had high inflation for the past few years. So most central banks engaged in higher interest rates, and they have started now lowering the interest rates. Of course, this is a very important variable, because that affects both the consumption of commodities, but also, more important, it affects investment. Under low interest rate environment, you have a lot of investment. High interest rate environments kind of impedes investment. It slows down investment, though that's the important variable. But of course, inflation, that I'm pretty sure you know about it. Now, in terms of what we expect about the price forecast, for the most part, we expect lower commodity price forecasts. In the case of oil, for example, which is the most important variable in our commodity market monitoring, Brent oil price, Brent is the international barometer of the oil price. We expect it to average $80 for this year. The year is almost over anyway. That's history, so to speak. And we expect it to go down to $73 for 2025 and fall even further in 2026. Agriculture, we are expecting a decline overall in agricultural commodities in 2025, because we pretty much have very good crops and some stability in 2026. And for metals, we expect them to remain flat in 2025 and drop a little in 2026. So this is pretty much the overall environment we are talking about for both global growth conditions and commodity markets. Just to elaborate a bit, I will go quickly through the global outlook. You see the growth rates for the growth for the global growth. One important aspect which is very relevant to commodity markets is that we separate global growth into two components. One is advanced economies, and the other is emerging market and developing economies. And those are the two bars, the orange and the blue bar. And the reason we make that distinction, and I would like to highlight this distinction, is because the emerging market and developing economies are the most important in terms of commodity markets, both in terms of consumption, production, and trade of commodities. So what matters for commodity markets is the orange part. And you can see those are the forecasts that we published in June, and we have some updates there from other organizations, because our forecasts are going to come out in January. We expect the 2.6 I mentioned for the next 3 years, including 2024. But for emerging markets and developing economies, we expect growth to be around 4% for this in the next 2 years. The two other important variables that I mentioned, the US dollar and the interest rate. To the right, you can see the very low interest rates. This is from the interest rates from the United States. But for all advanced economies, they have a similar shape. We had very low interest rates back prior to 2021 and prior to the pandemic, of course. But because of the inflationary pressures, central banks began increasing interest rates, and they went from something to virtually zero earlier in 2022 up to more than 5%. And we do see the easing that has started taking place in the United States and other places recently, but it's far above the low interest rate environment that we had back prior to 2022. To the left is the nominal US dollar index against, we measure it, or rather the Federal Reserve in the United States measures it against a broad index of currencies. When it goes up, it means the dollars appreciate. When it goes down, it depreciates. Now, in commodity markets, there's a very well-known relationship between the US dollar and the commodity prices in dollar terms, that is commodity prices. And there's a negative relationship, meaning that when the dollar appreciates, commodity prices in dollar terms go down, and when the dollar depreciates, they go up. Very interesting relationship. It has been tested empirically many times, and it pretty much holds most of the times. The reason I'm saying this is that we have seen the last quarter some appreciation in the US dollar, and some of you may have seen discussions in the financial press that with the new US administration that will take over in the United States in mid-January, we may see policies from the United States that will lead to a stronger dollar, which means this may continue to go up, or at least that's a forecast by many economists and analysts. So if that's the case, then we may see downward pressure on the dollar price of the commodity simply because the US dollar may appreciate. So this is a very important variable to watch, rather those two variables. Before I move to commodities, just to give you an idea of what happened in the global environment, we had a huge inflationary pressures during the past 3 years. It all started with a pandemic when we had the supply disruptions that a lot of goods could not move from one place to another, so you had very limited supply, and that pushed prices of most commodities up, and that in turn contributed to not only commodity prices of other items, and that contributed to inflationary pressures across many countries in the world. Here I'm showing you the US and the Euro area. And you can see, very important to the right, how food price inflation pretty much skyrocketed in both the United States, but especially in the European Union, where it reached a high of, 18% in early 2023. That was the main reason why central banks began increasing interest rates to slow down the rate of inflation. Now, higher inflation was not only the case for the United States and the European Union, but if you look at a number of other countries, you also see the same pattern, increasing in the first quarter of, let's say, 2021, reaching a peak in the first quarter of 2023 and coming down now. But again, this is a global average, and I have separated again the countries here in terms of advanced economies and emerging market and developing economies. But regardless of how you look at the countries, the pattern is pretty much the same. Increasing, reaching a peak of in the first quarter of 2023, declining, but prices now, inflation rather, is a bit higher than the target by most central banks. So central banks are not done yet with the fight against inflation. Yes, please go ahead.
If I may go back a little bit, what's driving the appreciation of the US dollar?
That's a good question. I think the main reason is whether the US dollar becomes an attractive investment option. I mean, whether agents, whether it's central banks or private agencies, would like to keep dollars. So that's one of the main reasons. I would say there are a number of other reasons in terms of trade balances, and policies, interest rates, of course. But again, all those lead to one ultimate aspect, which is whether the US dollar is an attractive investment option. Well, not yet. Now, interest rates, that's a good question. Let me emphasize this. Everybody talks about dropping interest rates, but look at, we only had 2 drops. We got a lot of news because the first drop, just to point here, that was a 50 basis points and another 25 basis points, and that made a lot of headlines about about lower interest rates. But in fact, interest rates are are still high by historical standards. Historical standards are recent history. If you go back to 1980s, etc., we did have interest rates at that level. So it's not low. Sorry, yeah, go ahead.
2.4 growth is in nominal or
Real, yeah. Okay, yeah, please go ahead.
So you mentioned that there is this reverse relationship between the dollar and oil price, which is quite true and quite significant, especially before 2020. But we can observe that since 2020, the relationship is kind of broken indeed. And there is a lot of explanation, but it's not quite clear.
I have seen that. In fact, to be honest, we are going to do with my colleagues some research to answer this question. This is true. If you look at the correlation, this negative correlation, in fact, if you look at this correlation historically, like let's say you go back to 1980, you do find periods that this relationship between the negative relationship between the US dollar and commodity prices does not work. And I have seen a lot of reports mentioning that. I have not done research on my own. I have not looked at this. Perhaps I should do. In fact, I was thinking of doing some research on this. But let's not forget one aspect, that commodity prices are a function of many things. They're just they are a function, of course, interest rates. They're a function of production, consumption, trade, policies, growth, and on. The list goes on and on. And we have done quite a bit of research on those aspects with my colleagues in the World Bank, and we have kind of quantified those relationships. So the fact that you do not see much correlation, it doesn't mean that the relationship is broken. Again, I have not done research on this recently, but doesn't mean it may mean, in fact, that there are other factors that dominate the price movements of commodities, and the relationship is still there, but you just can't see that because you are just looking at one relationship. But you raised a very important question, and I get this question when I make a presentation on commodity. I always get this question, and probably I should do some research too. Yeah.
Perhaps John.
Also, Saudi Arabia and China. So perhaps it's why it's the ratio.
Yeah, that's a good point. First of all, we have seen that, especially after the war, Russia-Ukraine war, we do see Russia and China doing bilateral relationships. I don't know whether this has affected, because I don't think it takes place at a large scale. What you just said, it does take place. I mean, and in fact, many countries, in fact, the BRICS, they have an initiative now, and they are trying to launch their own currency, so to speak. And then Trump, also the incoming president of the United States, made some announcement recently that he still wants, for obvious reasons, the dollar to become the dominant currency. So there's a lot of discussion on this, but the bottom line is that still most of trade takes place at dollar. So I don't think those are related, but you raised a good point. Now, my assessment is that from what I see, the dollar is still the dominant currency. I mean, it's whether you trust the United States, their president, or their policy is one issue, but people trust the currency. I mean, that's... Now, another aspect now that I'm thinking that you mentioned is that, of course, it depends on whether the country in question is linked to the dollar, because all countries in the Gulf, like Saudi Arabia, UAE, etc., they have linked their currencies with the dollars. So no matter what they do, even if they form, let's say, a currency, a component of which, let's say, is the currencies of the Gulf countries, the oil-producing countries, those are still linked to the dollar. So you still have the dollar element in there. So that's also another issue. Okay, enough about the macroeconomic environment. Let's move about commodities, because that's the core of my presentation. And what we have here is the 3 commodity price indices, energy, agriculture, and metals, from January of 2018. I have highlighted the area in the middle, beginning in January of 2020. And the only reason I highlight it is because we had a lot of developments during this period. Of course, the pandemic was the most important development. Then we had the war in Russia and Ukraine. We had the conflict in the Middle East, etc. So, and you can see that during this period we have quite a bit of volatility. Now, in terms of what those price indices represent, energy has 3 components: oil, natural gas, and coal. Oil is the dominant component in energy. It accounts for more than 80%. So when you see the energy, our energy index, that is pretty much oil. Then we have metals, which are pretty much the known metals that, you know, what they call the base metals: copper, zinc, aluminum, etc., plus iron ore. And then you have agriculture, which is a very broad index. It includes food commodities such as rice, wheat, and corn. It includes edible oils such as soybean oil and palm oil, but it also includes raw materials, cotton, natural rubber, as well as what we call beverages, the beverages we drink: coffee, cocoa, and tea. The bottom line is that the shape of all commodity prices, or rather the trend, is pretty much similar. A bit of a decline during the pandemic, the post-pandemic recovery, another boost at volatility during this period, Ukraine and the Middle East. Prices declined, and we are pretty much returning to a stable period. So 23, 2024 for commodity markets have been quite a stable period, regardless, despite of what is happening around the world, both in terms of Ukraine, Middle East, etc. And we also had a stable period between 2015 up to 2020. So the key difference is that today prices are higher than what they were prior to the pandemic. Now, those are nominal prices in US dollar terms. So they're about, I would say, 30% higher now on average than what they were prior to the pandemic. Of course, each individual prices has it's different, but when you average them out to these groups. Now, if you take into account that we have about, I don't know, 15 or 20% inflation during this period, we still have commodity price today being about 15% higher in real terms than what they were prior to the pandemic. So the two takeaways from this chart is that now prices have been stable for the past 2 years, but they are higher than what they were prior to the pandemic in nominal terms, of course, but also in real terms in about 10 to 15%. Moving to energy commodities, again, as I said earlier, our energy price index consists of 3 main components: oil, natural gas, and coal. Oil is traded around $80 per barrel, the Brent, which is the international barometer that we use to compose our energy price index. Natural gas is a very interesting commodity in many aspects. First is natural gas. Oil, for example, is an integrated market. You can talk about a global oil market, but this is not the case for natural gas market, because natural gas has to be transported by, it's very difficult to transport gas. You either have to have a pipeline or you have to convert it to liquefied natural gas, which is a very expensive process. And depending on the region, some regions are connected with pipes, some regions can only buy natural gas through LNG. That's why you have separated markets in natural gas. And you have the North American market, which is pretty much the solid line here. And then you have the red line, which is the LNG, and you have this line here, which is the European natural gas market. That you probably, some of you remember what happened in Europe in the first quarter of last quarter of 2022 and the first quarter of 2023, when prices increased by a factor of 10. Now natural gas prices have come down, but still European and LNG are about twice as high as they were prior to the pandemic. In the case of the US, natural gas prices are even lower than what were prior to the pandemic. Those are nominal terms. Now, this has important implications for a number of reasons, because as you can see from this chart is that those prices make the United States much more competitive than what we have in Asia and especially Europe, so that high natural gas prices put a lot of pressure on companies. That's very relevant for fertilizers, because nitrogen-based fertilizers and some phosphate use a lot of natural gas for the production process. So whether you are based in North America or in the Middle East, even better, if you have a lot of gas, you have a competitive advantage versus others. So that's a very important development. Now, to the right, we have coal. And what's interesting about coal, and it's very important that I would like to highlight this point, is that you see the shape of coal is the same as the shape of natural gas, like either this or this. The scales are different, but it's important. And coal now is traded at around $150 per ton, while in fact it was traded at about half that prior to the pandemic. There are a number of reasons, The main reason for this is that coal is used for the most part for electricity generation, but also natural gas is used for electricity generation. So in many places in the world, if one commodity becomes very expensive, they switch to other, because natural gas became very expensive. A lot of electricity generation switched to coal, and that's why you have this kind of similar shape in the two. And the other aspect is that in China, I'm pretty sure you know that nitrogen-based fertilizers used from coal, not natural gas. So that's probably another reason why we see the increase. Yeah, go ahead. They are producers and exporters, so they have a lot of natural gas production and exports. Yeah. That's and then because the markets, as I said, are not very well integrated. Even if they have a lot, if you produce a lot of natural gas in the United States, you cannot consume here in Rabat. Somebody has to liquefy it, transport. Gasify it. Liquefy it, then reverse the process here. So it's quite a bit of. That's why you have the difference. Yeah. Sorry.
For natural gas in Europe, does Germany recover from the Nord Stream explosion, or it has less impact in industry?
I cannot give a precise answer to your question, but from the chart I can see that Europe has a big problem in an energy problem, and when we say an energy problem, a natural gas problem, and energy generation, not oil, because Europe is a net oil importer. Prices of oil, as you can see to the left here, they're a bit higher than what they used to be, but not that different compared to prior to the pandemic. And then oil is traded the same way it used to be traded, so there's nothing in oil there. The issue is natural gas. The outlook for the natural gas is that for the foreseeable future, Europe is going to have, both Europe and East Asia, they're going to face higher natural gas prices unless we see a lot of conversion to other types of renewable energy sources. We may see a lot of more LNG form coming out of the United States and perhaps the Middle East. In fact, one of the Trump administration, they have indicated that they're going to start pushing for more liquefaction facilities in the United States, which means we're going to see more export of natural gas from the US. Presumably we'll see more from the Gulf states, but that's something that it takes place in the long term. It's not something that you can do in a matter of days or months. You have to wait years before all those facilities, because for natural gas, for the liquefaction process, you have to build a terminal where you take the natural gas, you liquefy it, then you have to have the right transportation mode, like a ship that takes, and then on the other side you have to put it back into a gas form, and you have to connect it to the network. So it's not an easy process. So the short answer to the question is that Europe is going to face higher natural gas prices for the foreseeable future. Yeah. That's right. Yeah. That's right. Yeah.
segmented indeed.
Good points. I don't want to get too much, but yeah, you're great points. Yeah. Now, what happens in oil? As I said earlier, the price of oil did not change much compared to prior to the pandemic. And what happens in oil supply and demand? To the left, we have data from the International Energy Agency. That's where we get most of our data for the oil market. And what I'm showing here is the oil market balance. And what we have here is that basically we have the difference between consumption and production. For this, it means that there's more production than consumption, and for the negative part, it's the other way around. But what I would like to highlight is this part of the chart, so does the forecasts by the International Energy Agency about the balance of the global oil market for the next 4 quarters, for 5 quarters, and what they project is that we're going to have quite a bit of surplus in all 5 quarters, which means we're going to have plenty of oil in the oil market, or that, at least that's what the International Energy Agency expects. So we're going to have surplus conditions. So on the supply side, we have quite a bit of oil there. When you look at the demand sides, so we have an interesting development there, is that in 2023, the demand of oil, it reached about 2 million barrels per day. Now, just for context, global oil consumption is about 100 million barrels per day. 100. So in 2023, it grew by 2 million barrels per day compared to 100, which is the global. Now, the long-term average, or at least the 10-year average, is 1.4 or 1.4 million barrels per day. That's how much the global market of oil grows in terms of demand. So in 2023, we had an exceptional year, and most of it went to China. It's the blue part of the bar. So China pretty much absorbed as much oil in terms of growth as it is the long-term average. Now, a lot of this was post-pandemic, when China, you may remember that it has closed down because of COVID, its economy. So when they reopened it, we had this huge growth. But for 2024, which the year 2025, the growth in China is much, much smaller. You can see the blue bar is much smaller. So we have a contraction of, not contraction, the growth in China demand of oil is very small compared to the recent history. So part of it is because of the post-pandemic pent-up demand, etc. But part of it, it's very interesting. It's because China is a leader in electrification and gasification of its fleet. So what we see, and I was surprised when I was reading that when we were doing our report, is that in China, of course, you have a huge penetration of electric vehicles. So they use less, increasingly less oil for the passenger cars. But what was surprising is that I believe, from what, if I recall correctly, about 2/3 of the trucks in China are using natural gas. So they have replaced diesel trucks by natural gas. So the reason I'm highlighting those 2 aspects is that what we see here is the low growth in demand by China. It has also a structural component. It's going to stay, the demand by China is going to stay low, and elsewhere in the world. So in fact, despite of what we see in the press about the electrification growth across around the world that has slowed down, etc., it starts having an impact in the oil market. So this is the very important element of the global oil demand. On the production side on oil, very interesting developments there. What we see in the United States is that after the second quarter of 2021, we have a huge increase in production of oil by the United States. Again, remember, 100 million is the global production of oil. United States accounts for about 20 million. So there's a lot of oil. Some of you may have seen different numbers for the United States, like 15 million barrels. I'm showing you 20 million barrels. A lot of that difference is because a lot of oil in the United States comes from what they call it liquids, natural gas liquids. So trust this number that this is part of the 100 million. So we see this huge increase in the United States. In Saudi Arabia and Russia, which are the 2 other most important producers, Russia is very interesting because it produces about 10.5 to 11 million barrels per day, 10.5 now, and this is pretty much as much as they were producing prior to the pandemic, prior to the war in Ukraine, and of course prior to the pandemic, which means that despite all of the sanctions that have taken place in Russia, etc., most of oil, or all of oil, that Russian oil still keeps going out of the country at the same rate as it used to go to export. They used to export prior to the war in Ukraine. There's a key difference, of course. Most of the oil now, there's some estimates around 2/3, I think, or 70%, that most of Russian oil goes out through the so-called dark fleet, meaning that they do not go through the regular insurance channels that they used to export the oil prior to the war. So the bottom line is that Russia exports as much oil now as they used to export prior to the war in Ukraine. In Saudi Arabia, you can see the post-pandemic pickup and the downturn that has taken place. I'm talking about this line, this decline that has taken place, and this reflects, for the most part, the reduction in Saudi Arabia production in response to the OPEC Plus cuts. They have removed something like 1.5 million barrels per day. Saudi Arabia alone, and the rest, 1.3 million barrels per day, has been removed by other OPEC countries. So 3 messages here. Oil by the United States keep increasing. Russia exports as much oil as they used to produce, rather as they used to produce prior to the war. And Saudi Arabia has taken a huge decline, mostly in response to the OPEC Plus cuts. The last slide on oil, let me skip this, it's a bit too much, not complicated, but I would like to focus on the right. To the right, we have the OPEC Plus crude oil output in September. That's just for the month of September, year on year. And that's versus, no, I'm sorry, not year on year, versus the target. See, OPEC Plus has agreed on a certain target. OPEC Plus includes, in addition to OPEC, some other countries such as Russia and Kazakhstan, etc. And you can see that some of the countries produce much higher than what is the pledge they had. They produce more than what they were supposed to be producing under the cuts. For example, Saudi Arabia, it doesn't produce much more. It produces, think of this line as respecting the cuts, so to speak, following the cuts, and to the right that you produce more than the cuts. So that's important because OPEC Plus is under increasing pressure now, especially Saudi Arabia, because Saudi Arabia has taken quite a bit of oil out of the market, but there are other OPEC Plus members who bring oil into the market. So OPEC recently, I thought I saw it either yesterday or the day before, announced that they're going to continue their cuts for the first quarter, I believe, of the first quarter of 2025, because the cuts that they have introduced are supposed to be in place until the end of this year. The reason I'm bringing this issue up is very important because, as I showed you earlier, in the oil market you have pressures from the production side, the United States, Russia. You have pressures from the demand side, but you also have pressures from the policy side, the cuts. So you have 3 pressures in oil markets, and all 3 pressures point to lower oil prices. So those are the 3 points, the main point that I would like to make on the oil market. Yes, please. Good question. We've done quite a bit of research on this, and I can share a couple of papers that we did. Yes, usually that's what happens. At the beginning, you have a shock in the global economy, then the OPEC or OPEC Plus get together, they discuss cuts, they agree, they introduce them, they agree. For a few months, they are in place. Then one by one, the members start cheating, so to speak, and then at the end of the day, yeah. So the answer to your question is, history at least has shown that this is the case, yeah. Yeah.
Downward pressure on the price of oil
That's right. Yeah. That's the point I would like to make. That in fact there is a fourth point. The first point was that you have too much oil from the United States. Russia still exports oil. You have pressures from OPEC, but we also have quite a bit of spare capacity here. So we have half of which is held by Russia, the red part. Basically, spare capacity. You can think of that as that this oil can come into the market at a very short notice. I mean, all the machinery, so to speak, is in place, equipment is in place, so they can decide they can ramp up production. And this is almost 7 million barrels per day. So it's 7%, it's a lot. Even if 1/3 of this comes on the market, then that will have it's likely to have a huge impact on the market. Now, what's interesting is the chart to the right, which I was surprised when we were doing the report. I had not monitored it for a couple of months. As I showed you earlier, you have this increase in the United States in oil. Now, this, what we call it US rig count, those are, you can think of this as active operations, rigs, so to speak, or active operations that produce oil in the United States. It has come down quite a bit, which is contrary to what I showed you earlier. So, and then I did quite a bit of research on this, and basically what you have in the United States is huge increases in productivity and technology. And that's why in the United States they are able to produce more oil by using less rigs or less active operations. So that was quite surprising. So here you can see another fifth pressure, the technology pressure on the oil market. So the bottom line is that the oil market is well supplied, relatively weak demand, and the risks there are on the downside. Since we are talking about OPEC, just to give you an idea of what OPEC and OPEC Plus looks like. OPEC consists of 11 countries, I believe, and I have data on the OPEC share since 1970. And the red lines, the red portion of the line is OPEC Plus, is the share of the additional countries that have agreed with OPEC, and you can see the countries here, what we call non-OPEC partners. We all know, most of us know, that about OPEC Plus. So this is the OPEC portion, and this is the OPEC Plus portion, the additional countries. But there was another OPEC Plus. I just wanted to indicate that to you, that took place in 1999 and 2000. So what happens is that when OPEC has pressures on the price, it invites partners to come in and introduce cuts. So just for a historical reference. Before I finalize the energy part, you can see here, I'm showing you the natural gas inventories in Europe, and you see this kind of cyclicality, that inventories go down because they use a lot of gas throughout the winter, and they go up as they put more into storage, which peaks in October and November. They start going down again. So this is a typical chart that holds for any country that uses natural gas as input for various aspects. And you can see in 2023, Europe did quite well. So the storage was on the upper range. I'm sorry, this is the range between, this shaded area is the range between 2017 and 2020. That's how it's fluctuated. And you can see that in the red here, which is the storage in 2023, it was on the higher end of the range. In 2024, they did much better, but we see a gap now developing compared to 2023. So there are a few issues in Europe. They have used, because of the winter, more natural gas than what they would have liked to use, and that's why we see an upward pressure in European natural gas prices recently in the last couple of months. Of course, a lot in the natural gas prices depend on the winter. What happens if the winter is harsh or mild? And the last year and the year before, there were mild winters. And talking about LNG exports, you remember earlier I was talking about the three markets, etc., or on the natural gas markets. You can see to the chart to the right, going back to the question on Germany, the destination of US LNG exports. And you can see here that Europe was taking about 30% or 35%, 1/3 of LNG exports back in 2020, but it doubled its exports from the United States. It doubled imports from the United States. And now it's going down. And the reason I'm putting up this chart is that certainly we're going to see a realignment in the global natural gas market. And that's an indication of it, that we're going to see certainly more of LNG facilities around the world. We're going to see, depending on developments in Russia, Ukraine, and Europe, probably most of Russian natural gas is going to go through pipeline to Asia. And then most of the natural gas coming to Europe is going to come through the LNG form. So the readjustments that we see here, probably they are going to continue down the road. Just a bit of metals. To the left, we have the metal price index, what we call the base metals, which are the refined metals, aluminum, copper, zinc, etc. And the red line represents the iron ore, which is an ore. We do see an increase in the price of metals, in the price of metals, especially the base metal price index. We saw a pickup here throughout the first 2 quarters of 2024. That's very interesting. It's something that I would like to highlight. When it comes to metals, the main story in metals is China. China consumes about 65%, more than 60% of the world's metal production. Just for reference, back in 1995, China consumed only 5% of global metal supplies. Now it has reached 65%. So China is the main actor in the metals markets. Of course, not all these metals stay in China. China imports metals. They make various manufacturing goods. Some they stay in China, some they export it to other countries. But what happens in China is basically affecting the global market of metals. And it's very interesting. Let me skip the chart to the left, but in the chart to the right, I'm showing that China's fixed asset investment growth. We have seen a lot of reports and articles about China, how its property sector is in recession, it suffers, etc. And the expectation is or at least the expectation by many commodity analysts, is that because of the problems of the real estate sector in China, that would have affected the metals markets, and many sort of expected that the metal market prices may collapse. But in fact, we didn't see something like that. And as I showed you earlier, the metal prices have kept quite high. But that reflects the infrastructure sector. You see, it holds quite well. So that's what I mentioned earlier, that metals markets, metals go mostly to China. 2/3 of world's metal production goes to China. Some of it stays in China. What stays in China is kind of, some of it goes into real estate and is in trouble. But then the infrastructure, metals that go for infrastructure, and part of it is exported, then it's quite healthy. And that's why we have not seen a collapse in metal prices, despite the fact that the property of the China is has various issues. Yeah. So. This China, yeah. Yes, I mean, I'm doing some, not research, some reading on this. Yeah, they try to prop up the property sector in China. There are a lot of policies, but I don't know if the long-term success of those policies, because the bottom line is that China has built a lot of property infrastructure there, and we have all seen reports about, towns that have not been occupied by humans. They are completely empty, ghost towns, etc. So no matter how much of a policy you do, there's not much you can do. You cannot make up people and populate the cities. Exactly, yeah. Okay, that's why I don't want to get too much of this chart. I kept it here. This is a year-on-year change. This is growth. You had quite a bit of growth. For example, if you take January of 22, that indicates the growth January of 2022 versus January of 2021. Now, we don't have much growth in OECD demand. Just we had post-pandemic recovery, and now it kind of went down. But yeah, this is it's important for everybody to realize that this is growth, year-on-year growth. The fact that goes down, you may have 1 month or that goes down, and then that pretty much shows up for. So the last slide on metals, this is precious metals, and what's interesting about precious metals is that have been going up. Here for the past 6 years, we have seen the price of gold reaching almost $2,700 US dollars per troy ounce. What's interesting in this chart, I found it quite surprising. When we rebase it, we see that pretty much gold and silver prices, the trends of those two prices follow each other very closely. Now, gold is a commodity that does not have much industrial use, is mostly for store of wealth and purchased by central banks, etc. Now, silver is a commodity that is kind of shares some of the characteristics on the gold market, but is also an industrial commodity. It's a very important commodity now for electric vehicles. Apparently, some parts in electric vehicles and batteries, they do use some silver there. To the right, we see the spike. Most of the analysts and economists attribute this spike to the geopolitical issues. That's why we see this price spike in gold. But we also have seen an acceleration of purchases by institutions of gold. You can see that in the chart to the right, which we measure how many tons per quarter are bought by institutions, and we see an acceleration in buying of gold by institutions, especially central banks. And that relates to the very earlier question you mentioned about the dollar as being the dominant currency, etc. That's another attempt, sort of the diversify out of the dollar, but anyway, that's small in the global scale. Let me move to agriculture. I don't know how much time we have. Okay, great. Yeah, so now, earlier on, I showed you the agricultural price index in the first chart. Our agricultural price consists of 3 main components. One is the raw materials, the red line, which is cotton, natural rubber, and some timber. There's the food, the blue line, which is the food kind of the food index, which is the most important component. And the food is, the corn, soybeans, wheat, rice, etc. It's a dominant component. And then we have the third component, which is the beverages, and as the term indicates, it's coffee, tea, cocoa, etc. And you have 3 pretty much trends there. You have a stable trend for the raw materials. So you have the food component, which is the trend that we have seen mostly in most commodity prices, stable prior to the pandemic, increasing with some volatility and stability or declining after the pandemic, but higher than before the pandemic. You can see 90 here, you can see 120 here, let's say 40% increase, half of it inflation, and 20% real terms. So in food, we see a trend that we see in most commodities. What's interesting in beverages, we saw stability, increase, and then we see beverage price which have literally exploded, skyrocketed. And what's interesting, the very last spike is the prices that we got yesterday from the month of November. So which means, as you can see, we're still at almost near record highs. So why is this the case? I have some ideas that I'm going to share with you about beverages. I have not done a research. Probably I will do with my team some research down the road. But there are some special characteristics of the beverage commodities that I would like to highlight, and those are that those beverage commodities are tree crops, like coffee, cocoa. So those are tree crops. Those are geographically concentrated, like you cannot produce coffee everywhere in the world. It has to be produced in certain parts of Latin America, Africa, and a bit in Asia. And they do not have close substitutes. You have coffee, okay, you can argue that coffee and tea are substitutes, but pretty much the substitutability between coffee and other commodities or cocoa is very low compared to the substitutability of food commodities. And of course, the other characteristic is, I know I don't want you to laugh, that if you have a coffee tree, you cannot produce cocoa out of a coffee tree. The coffee tree will produce coffee. The cocoa tree will produce cocoa. Now, this is very important. It's very important for the following reason. If you have a plot of land, you can grow wheat this year, but you can grow maize next year. You do not have a lot of flexibility, but you have some flexibility, which you can grow one vegetable this year, you can grow another vegetable next year. So you have a plot of land with some labor and inputs such as fertilizer, chemicals, and labor, and you pretty much can produce everything. In contrast, if you have a coffee tree, you can only produce coffee. And the other aspect is that when you make a decision to plant rather coffee in a farm, you get stuck with it. You plant coffee trees that are going to stay there for 30 years. The same way that a copper mine, you open a copper mine or a fertilizer mine, it stays there for 20, 30 years or whatever is the life. So in a sense, tree crops follow the same logic as the industrial commodities. So you have huge investments, not much substitutability, not much flexibility. And my question, and again, I don't have an answer, but hopefully I'll have an answer, is probably because of those constraints, we see the effects of weather changes, climate change. Because my sense or my assumption here, my take is that if there is climate change issues, I'm not questioning this, but I don't know the extent to which they affect commodity markets, etc. But if there's an effect on commodities, we're going to see it in tree crops first, and then we're going to see it in other crops because of the issues that I mentioned. And the other crops, most of which are like wheat and maize, etc., most of which are grown in temperate zones, you can also expand. I mean, if you have climate change, you can go a bit north or a bit south, but you do not have that much flexibility in coffee. Yeah, I'm sorry, in tree crops in the short term, in the medium term. Now, it's also important because, as I said earlier, beverages, the index we have here consists of coffee, cocoa, and tea. But there are a number of other commodities that have followed a similar pattern, and that's oranges and olive oil. You may have seen the price of olive oil. I mean, you consume quite a bit and produce in the region. So we see this pattern that tree crops, especially the ones that are geographically concentrated, have been affected. We have seen the prices pretty much spiking, while for the other crops, again, this is just a food for thought, that meaning that we may have seen the effects of climate change in the tree crops first, and perhaps we're going to see similar behavior in the other crops, but that's down the road. Again, I have not done research, but to me it's very interesting that all tree crops have kind of issues there in terms of...
Is this like permanent when you say climate change? Is this permanent change in the production structure of these crops?
I think so. I mean, okay, nothing's permanent in the sense that if you take olive oil, it's produced mainly in the Mediterranean region. Okay, it's affected. Now, it doesn't mean that olive oil can only be produced in the Mediterranean. It's what we have seen so far, historically. I mean, from what I see, some reading that I've done, and I've attended a few conferences, the workshops, etc., olive oil can be grown in California. They grow quite a bit of oil. In Brazil, they grow olive oil. In China, they grow quite a bit of olive oil. In fact, it's very interesting that I was attending a conference in Greece. It was very recently, like earlier this year. And there was a presentation about olive oil, about the quality of olive oil, the presentation about some award, which region or country got the award for olive oil. It was very interesting. I come from Greece, and I know that Greece, or at least I would like to believe that we have good olive oil there, high quality. But regardless, there was this award competition that was in Greece, took place in Greece either last year or the year before. And I think the top 10 awards went to regions that had nothing to do with Mediterranean, like Brazil, China, California, or whatever. Now, the reason I'm saying this is that it's not like we will not see olive oil in the long term. Olive oil will disappear. It may be produced in other regions of the world, but it goes back to what I said earlier, that to invest in olive oil, in any tree crop, let alone that you have to do a lot of research to find the right varieties, etc. But then you are investing in something that, again, olive trees you invest in for the real long term. They get stuck there for hundreds of years. So
At least in Morocco, when it comes to olive oil, this year is exceptional. We had heat wave. Spring, which meaning that next year we might get better production. So
yeah.
basically, my question, for example, for coffee or cacao, is that the question is that we suffer exceptional weather event that for some reason was affected all crops simultaneously, or is it progressive, permanent switch in the structure of production?
Yeah. I wouldn't say that. I don't think it's the same, because from my readings that each olive oil was a drought issue. You didn't have water, as you correctly pointed out. Then in cocoa, from what I read, is a disease that affected Côte d'Ivoire and a bit of Ghana, because there was another issue in coffee. It was the weather. I mean, weather like frost or whatever. So if you look at each crop, is different what affects the individual crop. But my question or my argument is that you have this underlying force, more climate variability, which in some area may show up as a drought issue, in another area may show up as a disease, and in a third area may show up as a frost. And that's why I'm hesitant to argue that this is a scientific finding. It's I've not done a research, and you need quite a bit of research to establish that, in fact, but that this is the case. But I'm just putting that as a question or food for thought. Yeah, Chloe. Okay, another good question. We try. I say we try, very important. Do you know that from OCP very well, the pricing? The prices that we publish are as much closer as possible to FOB. Now, that's what I would like to publish to avoid the issue of transportation and insurance. However, we do not have to do good price indicators for all commodities to publish FOB, but our intention is to have FOB prices. Yeah. In coffee, unfortunately, we have London and New York. So in coffee. In tea, I'm just giving you some examples. We're close to FOB in tea. Coffee and cocoa, we are CIF. For grains, we are all FOB. For oils, edible oils like soybean oil, etc., we are CIF. So I'm getting a bit technical here, but your colleague here knows, asked a very good question. The idea is basically, when we have a price, do we take into account transportation costs and insurance, or we only take into account what takes place in the production side, in the source? And our intention is to exclude insurance and transportation costs. That's our intention, but we do not always have good price data. So we have a mix of everything, basically. Sorry? I should give another seminar on this. In fact, yeah. You see, the prices, we have individual prices. We mean the World Bank, because the reason I'm saying this is that if you look, let's say, at the FAO Food Price Index, what they do in FAO is that they take, let's say, the price of wheat, and they take the average price of 5 or 6 regions, or they create an index, and then they create a bigger index based on those, based on the wheat index, the rice index, on the soybean index. So that's their philosophy. Our philosophy is different. We're taking simple prices, and we're going as far back as close as we can to FOB. So that's our objective. The problem with our approach is that we do not have data all the time, because the markets have to be liquid enough to be representative of the world markets. So, yeah. So just moving to agriculture now, or rather to grains. To grains and edible oils, which is the main component of the agricultural price index, the food component. We have taken here data for the past 20 or so years. Those bars, the blue bars, indicate the growth of supply for each group, the growth of supply for grains and the growth of supply for edible oils. Now, grains consist of maize, wheat, rice, and the maize, wheat, rice. And then edible oils are soybean oil, palm oil, rapeseed oil, canola oil, etc. This is the annual change in metric tons, not in percent changes. And there's a good reason as to why we take metric tons per year. I'm not going into this right now. And the average change in supplies for the past, let's say, 25 years has been close to 50 million tons. Mean that production we add in terms of production for main grains 50 million tons every year on average. And this is the fluctuation. So this is the 20-year average, 24-year average. And this is fluctuation which reflects weather conditions, etc. This is the crop that ended this summer, and this is the crop that's going to end next summer, which is the forecast that we get from the United States Department of Agriculture. We do the same thing for edible oils. Now, here we are adding 50 million tons per year. In edible oils, we are adding much less, about 4 to 5 million. It's a much smaller group of commodities, but the prices, they're much higher in terms of value. The bottom line is that the crop that just ended for both grains and edible oils, which is the second to the last bar, was very good compared to the long-term average. So we had good supplies. The crop that is the ongoing, according to the forecasts, the oil, it's close to the average, so to speak. Not as much the grains. There are some issues in grains, but that's why we have seen a bit of volatility during the past few months. But still, the crop is on the positive side, and it's in between the long-term average and above zero. So the conditions are, I would say, comfortable. There are some issues, but not big issues in agricultural production. And the reason I'm concluding this is the following. The way to assess whether the crop is comfortable or not is to look at the inventories and compare them to the consumption, see how much inventories you have at the end of the season. For the ones that follow agricultural commodities, this is a so-called stock-to-use ratio. Stocks, which is inventories, versus use, which is consumption. We take this ratio, and this ratio in percentage terms is shown here. I've taken the three main commodities, maize, rice, and wheat, and I plot this ratio for the past 20 years, and we do see we reached a peak in most commodities around 2019, 2020. And since then, this ratio has gone down, which means when this ratio goes down, it puts more upward pressure on commodity prices. So there is a negative correlation between this line and the prices that we see in commodity markets. It's important to contrast that with what happened in 2007, 2008. Some of you may remember, some of you have read that we had a huge price spikes back then. So then inventories sort of build up. We have seen some negative downward trend in inventories the last 4 to 5 years, but we are much higher than what we were back then. That's why I'm saying that we have some tight conditions now, but compared to the history, we are much, much better. Now, what we have done to the right is that we took, yeah, please.
Are these stocks for inventories for the whole world?
Yeah, global, yeah.
There are estimates.
That's true, yeah. There are estimates, and in fact, there's a question as to whether we should be monitoring the global or we should be monitoring only the ones that are held by major exporters, which you can measure better. There's a good question there. In fact, we did do some research. We have not finalized it yet, and I think it's better to use major exporters. The data is more. There are two issues. The data is more reliable. There are three issues, in fact. The data is more reliable. It's what matters in the market. That's the third. And it's probably intentions that do we get the same data, good quality data from various countries, because some countries have publicly held inventories and they just don't tell us the right number, so to speak. So it's whether we get the right number, whether we have accurate numbers, or whether they're held by the entities that matter in the world. So there are three aspects there, back to your question. And probably exporters are, major exporters are better. We have done some research and that's what we have concluded. In fact, some agencies do report both, but regardless, the shape of the curve is the same, regardless. Now to the right, what we have done is we took all food commodities, 12 food commodities, and we aggregated them into one single entity by adding up the calorific content. So we took wheat, soybean oil, let's say, and the rice. We counted the number of calories and we added it up and we combined them into a single measure. So that's much nicer. That the one to the left is very busy, the one to the right is much cleaner. And this ratio was at 17% in 2007 when we had a huge price spike. It reached 31% in 2018. You can see the build-up of inventories, and it's now to 26%, which explains very nicely that we are in a bit tighter situation, but nothing compared to what we were back in 2007 and 2008 and 2010. So we're in a much better situation. That's why we see that stability in prices. If we reach a situation like that, then you are going to see a lot of volatility in prices. Coming to your area of expertise here, you know more than I do, or some of you know more than I do. We monitor 5 fertilizer prices. Since you know, some of you know about fertilizers, I also gave the exact definition of, for example, I was speaking earlier, you can see that we try to get FOB as much as possible. Again, fertilizer prices for the three main fertilizers, the same shape, low prices here, spiked, came down and a bit higher now than what they were prior to the pandemic. Of course, the middle high part, the middle spike is associated with a spike I showed you earlier on natural gas prices and of course coal prices. And to the right, I have taken the average prices between 15 and 19. You remember the stable period prior to the pandemic, the very first chart that I showed you, which is pretty much, it's also here. Then I took 2013 and 2023 and 2024 average, excluding December, 2 years, and I took the percentage changes between those two periods, nominal prices. And fertilizers increased about 66 to 67%, the same as precious metals, followed by beverages, energy, metals, and food is the raw materials, which did not change much. So those are nominal terms. So we see, if we take fertilizers, for example, we see an increase in this, I would say, in this 80-year period. If you take the middle of 2017, 23, in 6-year period, so you can think of this as 6 years. We see fertilizer prices about 65% compared to prior to the pandemic. If you take out 30% inflation, probably it's too much, 25% inflation, then you have 40% net increase in fertilizer prices during this period. So, which is good news for producers of fertilizers like Morocco, but bad news for users of fertilizers. That's always the case. I mean, always our colleagues and managers say, okay, prices is good, but it depends on if you're buying or selling. If you're buying, low prices are good. If you're selling, it's not good. So another measure of another way to look at sorry, yeah. Yeah. They're quite disconnected. Let me describe what our raw material price index consists of natural rubber, cotton, timber, and tobacco. But natural rubber and cotton are the most important components. Typically, we associate that, at least historically in my mind, they are the same, they have similar behavior as metals because they are raw materials. For example, okay, let me rephrase myself. Raw materials and metals are responding mostly to global GDP. That's why I showed you earlier on the global GDP. They are very important metrics to assess what's going to happen in the metals markets and the raw materials market. Now, what I have seen raw materials is that simply the prices of natural rubber and cotton did not increase. Natural rubber prices depend on a lot on car manufacturing, because natural rubber, 2/3 of natural rubber production goes to tires, which in turn goes to cars. And they just didn't increase as much as metals. I don't know, it's because of the pandemic and the less transportation and less cars and probably the clothing patterns, which affects cotton, they may have changed throughout the pandemic. But those are good questions that I can't pin down. One has to do research on natural rubber and cotton to see if in fact the pandemic has such an impact on. But now that I'm thinking about it, it's probably pandemic related consumption decline, both for cars and clothing. I don't know. I've read a lot on this, that with the pandemic working from home, you didn't have to wear ties and suits, etc. So I don't know whether that affects this index. But now, I think this is my last chart. The one way to look at the fertilizer price, of course, is to look at the price the way I showed you earlier. But another way is to take the ratio of fertilizer prices to either agricultural commodities or food commodities, and to see how affordable it is for farmers. And when we take this price, and again, this is the ratio of fertilizer to food price to food prices, the fertilizer price index and the food price index, it means that if this ratio is low, it's more affordable for farmers. Meaning good news for farmers. This is good news for farmers, but bad news for fertilizer producers. This is good news for fertilizer producers, but bad news for farmers. So now this ratio is pretty much to whatever it was prior to the pandemic. I have this kind of set it up to 1 here. Now, if you take the 3 components, the DAP, the potash and urea, you see kind of different, you see the same shape that I showed you earlier. Again, this is the ratio. I've taken here the ratio of the 3 components to agricultural production, just a bit different than food production. And what you see is that DAP, diammonium phosphate, is a bit higher in terms of affordability. It's better news for producers. Again, as I said, if you are above this line, it's better news for producers. If you're below this line, it's better news for consumers. So I would say, from what this chart shows, is that DAP is the best from a production perspective, and the least affordable from a consumption perspective. Now, another way to interpret that, it may be a leading indicator of what kind of price pressures are going to build up in each of the commodities. That if you are above the dotted line, so you would expect downward price pressures. So if you are below, you are expecting upward price pressure. So that's, again, that's very rough way of looking at those charts of the fertilizer affordability indices and the ratios. Now, as I said at the beginning of the presentation, our main job is to produce price forecasts, which is what I have here. We produce price forecasts in the report for, I believe, 45 or 46 commodities. I only showing you here the indices. We have the individual price forecast in the report. You can see the report for all commodity price, whether it's oil, MOP, or natural gas. And you can see the declines that took place, that are taking place this year, -3% for our total price index, and then -6% for our energy. You see the beverage issue that I discussed earlier, which is spiked, negative for the rest, and a 23% decline in the fertilizer price index this year. And you also see a lot of negative signs in 2025 and 2026, mostly negative signs, which means that commodity price, we expect them to be under some negative pressure in 2025 and a little in 2026. So this is our overall broad picture for commodity prices. In the report, this is the commodity markets outlook report. This is a 50-page report which has detailed tables and discussion on each commodity. There you can go and see a couple of paragraphs for cotton, for coffee, etc., and of course for energy, much more. In our unit, apart from this report, we produce the data once a month. We released our November price data yesterday. We publish them. We publish the price data on the second business day of each month. We monitor about 75 commodities. All our data and reports are online, free of charge. You just click and you get no passwords, no ID numbers. And for our main sections of the report, what we do is after we publish the report on the October 29th. So every week we take a section of the report and we summarize them in a blog. Yesterday we published a blog on coal market. The week before we published a blog on food markets. Next week we are going to publish a blog, I believe it's precious metals. So basically after we publish the report, let's say at the end of October, for the next 11 weeks, we're publishing a blog for each group of commodities. And this blog is quite good because in the sense that we summarize the entire sector in 3 to 4 paragraphs with nice 3-4 charts and a little abstract. So if you are waiting on a traffic light or to get on the plane or on a metro or whatever on the bus, it's a good opportunity to spend 10 minutes and read about what's going on in the coal market, oil market, etc. So with this, I'm ending my presentation and I'll be happy to entertain questions. Or I'm quite active on LinkedIn, so please use my LinkedIn account. You can connect with me. Send me an invite if you want, or you or your colleagues, and then I'll certainly accept it. And then whenever we publish something from the unit, I always repost it on LinkedIn, so you will be in a good shape, good position to receive updates and etc. If you have questions, send me an email, or you can ask me now or later about commodity markets, and I can either answer the question or I can direct your question to my colleagues. We have an energy expert, we have another agricultural. Oh, by the way, I'm an agricultural economist by training, but I have done quite a bit of work on energy, metals, etc. But we have another agricultural economist in our unit, a metal economist, an energy economist, and of course a lot of macroeconomists who have good knowledge on the macro aspects.
Actually, I have the question. I was always curious about the forecasting at the World Bank. That is, well, if you could walk us through the process by which you produce
Okay, it's not an easy answer in the following sense. It's not that we have a model and the model produces the forecast. We do have models. We have 2 kinds of models. We have some VAR models which are relevant for energy and metal commodities, which are handled by my colleagues. In fact, in the previous 2 editions of the Commodity Markets Outlook, we published 2 special focus sections which describe those models. So you can go back and see how that's for energy and metals. And I myself, with a lot of my colleagues, have done quite a bit of modeling, econometric modeling, in the sense of trying to explain prices within a reduced form econometric model, price as a function of fundamentals. And we get elasticities from those. Okay, what's the effect of, let's say, the US dollar on the commodity price, that the issue that we were discussing earlier, or what's the effect of global growth on the price, or what's the effect of stock to use ratio on the price. So we have quite a good set of elasticities there. So that's what we do in terms of modeling. Then we look at, for the commodities that are traded in futures exchange, we look at the behavior of futures prices. Not all commodities are traded at futures exchange. For the ones that are traded, especially metals, energy, and the main agriculture, we look at futures prices. We subscribe to a lot of commodity reports that you probably do in OSP, and we get expertise from them. We also get a lot of information from our colleagues from the macroeconomic side to see what's the state of the global economy. And we use our own judgment. As an agricultural economist, I look at what the USDA says, what my colleagues from the energy economist looks at, what the International Energy Agency says, what the metals at other publications. We look at what the FAO, the Food of Agriculture Organization, says about food markets, etc. And we combine all of this information to come up with the forecasts. So the bottom line is that the forecast consists of modeling, futures, market assessment, and judgment, 4 components. Now, we do the forecast individually for each commodity. And then we do not forecast indices, we forecast commodities. And then we build up the index. And then we see what the index looks like. And then we look at the index and we also compare it with the state of the macroeconomy. And we see if that makes sense to us. Okay. And if we see something, or our macroeconomist tells us something that does not really fit well with the thinking, then we go back and we see at each individual commodity to see, did we get everything right on the individual commodities, or there's 1 or 2 commodities that drive the whole change and give us a picture that it's not consistent with our thinking. So the short answer to your question is a complicated process. It's not a model or just judgment or whatever, but that's how we do the forecasts.
Let's call it accuracy. How accurate would you assess commodity forecasting compared to macro forecasting?
That's a good question. I don't know. I cannot answer this question for the following reason. I mean, I cannot answer, but I'm just thinking, how could I answer this question? The problem with the commodity prices are very volatile, as you know. I mean, things can go up by 50%, by 40%. While growth forecasts, growth is not volatile. Growth is very smooth. You have volatility in growth on very few occasions, like we had in the financial crisis in 2008, 2009, that you had a downturn, and we had another one in the pandemic. So if you exclude those 2 periods, which are shocks basically in the global economy, macroeconomic forecasts, growth forecasts versus actual, which is the accuracy, so to speak, differs very little. Very little. So you project 2.7 growth, and in fact, it turns out to be 2.6, so or 2.5. Let's say if you exclude financial periods with financial stress. When it comes to commodity prices, you can forecast, in oil, for example, which we are saying we're going to go down $7 next year, below this year. I don't know. Who knows? That's right. I mean, oil can go up to 150 and go up to 30, let's say. I'm not saying I believe it will, but we have seen this range recently. And it can do that you don't have to have turmoil in the global market in order for commodities to do that. I mean, you see what happens in beverages, for example. You have a skyrocketing, it's 55% within a year. The short answer to your question is that's right. Given what we see in commodity markets, we have a downward pressure next year, which may persist even the year after. And in fact, I was doing some reading for fertilizer markets before yesterday and some other markets, and that's consistent, the downward pressure across the board. Despite of what may happen in terms of, even if you take into account likely trade frictions and the interest rate pressures and the US dollar pressures, even if you take into account all those factors, we still believe that the downward pressure is probably the outcome. Okay, you have links within commodities between, let's say, coal and natural gas, or maize and wheat, or copper and aluminum. So you have those links, which each economist takes them into account. But then we all of us, we are discussing, especially we are discussing amongst ourselves. The big issue is how to have the links between energy and non-energy commodities. So that's one link. And the other link is what happens the global demand, the growth kind of. So those are the two big questions. So when it comes to growth, interest rates, exchange rates, etc., we discuss it with our macroeconomic colleagues. And when it comes to links across commodities, we discussed it among the group. Now, one good thing about our team is that, as we were saying earlier on private discussion, is that we look at across a broad range of commodities, so we get a sense of what's going on, whether it's natural rubber or oil or fertilizers. So we have this broad range of commodities. And we also collaborate quite closely with our macroeconomic colleagues. So if we have issues, we discuss them. So we have this broad range and macro link that gives us a niche, so to speak, or comparative advantage, if there is one. Yeah, the two, we've done, some of my colleagues have done quite a bit of work, and the institution has done a lot of work, and elsewhere, of course. What we see is that as the energy transition intensifies or accelerates, however you want to call it, we're going to see less use of fossil fuel energy. Makes sense. That's the whole thing about energy transition. And we're going to see a lot of use of metals, mostly metals. So the effects are going to be on energy and metals markets, base metals as well as critical materials, some other critical which we do not follow, although we are attempting now to integrate, to bring more commodities into our report to understand those markets. On agriculture, we don't see the link there is biofuels, because we have a lot of mandates and a lot of countries have announced policies and mandates for accelerated use of biofuels. That's the main channel that's going to affect agriculture, and of course the price of energy. So for agriculture, it's price of energy and biofuel mandates. For energies, of course, we expect less fossil fuels, and for metals, we expect more. A lot in the energy transition, and that's what we have observed in the past, is that it's going to be shaped by technologies. Then we kind of think that, or we believe that we're going to have more use of metals because of the energy transition, but we don't know which metals. There are certain metals that's in high demand now, whether it's lithium or copper. But with technology, we do not know if those metals are going to be the metals of the future. So exactly. I mean, there's a host of factors that take place here. The price increase, then a substitute. Like the best example is shale oil technology in the United States, oil. That shale oil technology was developed back in the late 1970s, early 1980s, after the 1970s oil shock. The problem was the technology was expensive. It was sitting on the shelf. Nobody was touching it. Because if you have oil at $40 a barrel, who's going to use technology which is $100 per barrel? But the moment prices went above $100 after 2010, then people look at the technology and they implement that. So that's...
I was curious if you could talk to us in more detail about this, specifically the fertilizer forecasting. Because it's In our experience, it's notoriously hard.
It's hard because it's one of the hardest commodities, and the reason is because fertilizers, you are pretty much sandwiched between two markets: the energy market and the agricultural market. So in order to have an accurate forecast for fertilizer markets, you've got to have good forecast for agricultural and energy markets, and you have this energy market fluctuation which can throw you off, and that's why the fertilizer it's one of the most difficult markets to forecast. It's not like when you forecast metals, you pretty much watch what happens to the global market in China. I'm just giving you an example. Or when you forecast agriculture, like the main agricultural commodities, wheat, maize, etc., you look at what happens to the major exporters and what policy aspects. You have the two things you are watching: what happens in Europe, the United States. Of course, in grains now we have Russia and Ukraine. Not much is affected on the demand side. Demand does not cause a lot of spikes in grains, for example. So you have a couple of things to watch. And the moment you have a good understanding of how policies and those countries do, you are doing well on energy. Is a bit more difficult because energy, you have also in oil, you have OPEC. You do whatever you do in your forecast. OPEC decides to extend the cuts, then it throws you off. I mean, in fertilizers, you have the problem that you have to do a good job in agriculture, you have to do a good job in energy, that you are just stuck in between. And that's why fertilizers are notoriously difficult to forecast. So that's one thing. The second thing is that, and in fact, OSEP had a conference on that about 8 years ago here in Rabat, I believe it was in Rabat. They looked at this issue on the benchmarks, prices. You see, for oil, we have good prices. We have Brent, which is the international barometer, but you have WTI, you have Dubai, you have a lot of others, and you pretty much know the dynamics there. We have good prices for grains, good price for metals. And by good prices, I mean prices that are international barometers that they reflect the global fundamentals. When it comes to fertilizers, natural gas, not the US, the other markets, and critical metals, those three groups of commodities, you don't have good barometers, global barometers. You don't have liquid markets there, as liquid as the other markets. So that's the second level of difficulty that you have in fertilizers. So you have two issues there. You have to watch many markets, and you don't have good barometers. They are not representative of global demand and supply conditions. Yeah, that's right. Compared to other commodities like oil, I'm not saying that there's anything bad with the MOB price of DAP, but that's what life is. I mean, you have the same issue in LNG, and you have the same issue in the critical materials. And those are the three markets where we have a hard time deciphering what's going on. There's not much you can do about it, but it's good to know what's the problem. Because if somebody accuses you, you are giving me what's going on with your fertilizer price, tell them it's more difficult than the other markets. Yet you don't have good information in the following. Not good information. No, you don't have a lot of information. Like in the oil market, even if you go into the Wall Street Journal or in the Financial Times, you will read something about the oil market. That pretty much it will be fine. I mean, there will be a good analysis. If you go to USDA, United States Department of Agriculture, Food and Agriculture Organization, you're going to get a nice report about what's going on in the rice market, the maize market, etc. You do not have that in fertilizers. A lot of reporting.
From what I understand, the World Bank uses exports of DAP.
Yeah.
Does the USDA?
No. Sorry. What's?
For the DAP. I'm not sure which price you're using. Some export from Congo.
US Gulf, yeah. US Gulf, yeah. FOB, US Gulf.
It's a national price. Where does the information come from? Is it just survey price? Is it producer price?
It's export price. We get it from green markets. This report, and it comes from surveys from exporters. from a price agency.
Ideally, for DAP, I would guess since it's used by farmers at the end of the chain, wouldn't it be more useful to have a survey of prices at the sale point?
At what farmers paid, you mean?
Exactly.
Yeah, that's another way. But then you add another complication there. That's a good point. But then the idea here, not only on fertilizer price or on our price, is, as I was saying earlier, to capture the global market and supply and demand conditions. Now, when you talk about farmers, okay, you're going to survey which ones to the United States. You have to go to China, India, etc. And globally, it's impossible to do that. And even if you get an average, there's so much distortion in between the FOB, subsidies, taxes, etc. So I'm not saying it's wrong to look at it, but if you want to do a study and say how much do Moroccan farmers pay for the fertilizer prices, that's fine. I mean, you can do that. It's a nice research to do and see how much is their cost compared to whatever they produce. If you want to calculate in terms of trade, to calculate a ratio like that in terms of, so you see, this is FOB price, FOB of fertilizer versus FOB of, let's say, food prices. That's what it is. Now, if you want to do a study on Morocco and you want to see how much the farmer sells the wheat versus how much they purchase the fertilizer price, then that's the price you're going to use. That's the price you're going to use. But for our purpose, I mean, we are just trying to scratch the surface and look at the global. But you are asking a nice, good question, which has it's a different nature. I mean, from your perspective, those are the prices that you should be from a Moroccan perspective. Now, for a global perspective, I don't think it's difficult to construct indices for prices paid by farmers. There, you have to use other summaries. So I'm just trying to give you a practical what you can do and what you can't do.
Okay, questions? Thank you, John.
Thank you very much.
John, thank you, John, for your presentation, which was very interesting and very insightful about the trends, the recent trends in commodity markets. And I shall thank the audience for participating with us this morning. And there is coffee outside for everybody if you want to. Thank you again, John.
Yeah, thank you very much. And, I was very glad that you were able to invite me here. And yeah, I'll be here. And